Hi there everybody, welcome back to another stock analysis video. Today we are going to be analyzing a really good company in my personal opinion, and honestly just one of my favorites in general because, well, it's actually very boring, and in the world of investing, guys, boring is good. You want a company to be really boring because it means that essentially there is no surprises when it comes to them. And what I'm talking about, guys, is the company, you're seeing it on the screen right now, WM Waste Management. Guys, they do have earnings coming up on Wednesday before open, so I figured, you know what, let's analyze this company one more time and see if maybe now that the markets have been falling a little bit, let's see if maybe now this company is a buy based on their fundamentals. So with that said, let's get started with this analysis. Starting off, guys, with the dividend summary. Current dividend yield of 1.68%, which ends up being 65 cents per share for an annual payout of $2.60. The payout ratio is at 46.75%. Now, this payout ratio is not in regards to the cash flow. We're going to take a look at that in just a little bit, but nonetheless, this is still looking fairly good. Now, the 5-year growth rate on this dividend, guys, is also decent at almost 8%. With 19 consecutive years of dividend growth. So they're almost a dividend aristocrat. Only 6 more years and they got this title in the bag. Ex-dividend date passed as of June 2nd. Payout date was June 17th, and they pay their dividends accordingly. Now let's come to the calculator, guys. Let's see what we can learn from this company. Ticker symbol of WM, market cap of $64.7 billion, PE of 34.39. So based off just the PE, this is telling me that with the current share price of $155.90, it's pretty much just telling me that this might be a little bit expensive. But we're going to take a look at other metrics to see what we can find out. Now, let's take a look at this dividend in regards to the current shares outstanding. As we can see, they almost pay out $1.1 billion in dividends every single year. Now, in regards to their 5-year average free cash flow, this is not looking too good, right? After this dividend is paid, they're only left with $882 million. But guys, if we take a look at the last year's free cash flow and we do the same math, we can see that they were still left with around $1.4 billion left. Now, the payout ratios in regards to these free cash flows is actually 44.35% for last year's free cash flow and 55.03% for the average 5-year free cash flow. So in both scenarios, they are still below by 60%. Even though the 5-year average one, they are left with less than $1 billion, it is still less than 60%. So this is all good, at least for my personal opinion. Coming now to the fundamentals, starting of course with the net income. 5 years ago of almost $2 billion to 1 year ago of $1.8 billion. Guys, that is a decrease, surprisingly enough, of 7%. The funny part here is that, well, from 5 years ago to 2 years ago, they were on the decline, and you would expect during COVID, people were at home, people were consuming a bunch of stuff, so you would expect this thing to be having a lot of net income during COVID, but apparently it didn't. They actually went down. So fairly surprising there, but this is actually kind of not good, right? They decreased their net income on the 5-year, and assuming that this year's is roughly around the same at around the $1.8 billion mark, well, we might actually see the same decrease once we get this year's numbers, assuming that we get roughly around the same. If we supersede obviously $1.9 billion, then this would essentially be increasing. But for now, guys, this is still a negative metric, decreasing at 7%. But that is just the net income. Let's take a look at now the most important profit metric, the free cash flow, cash from operations less your capital expenditures. Guys, this is what the company uses to pay out a dividend, make acquisitions, grow the company, buy back their shares, and pay down their debts. You want this thing, guys, to be increasing year over year, and of course you want it to be consistently increasing as well. What we can see here when it comes to waste management is 5 years ago of $1.67 billion to 1 year ago, guys, of $2.4 billion. That's a pretty good increase of almost 50%, with a 5-year average free cash flow of 1.96, or essentially $2 billion, right? Now what you can see here is actually fairly interesting. Good increase, and a good consistent increase as well, from 5 to 3 years ago. Dip during COVID to $1.7 billion, and then back up after COVID. So you know what, I guess we just have to take this number as a COVID related number, and that this might actually just continue to grow at the same rate within the next couple of years because, well, they do have precedent for this given the 5, 4, and 3 year ago metric. Now let's come to the revenue, guys. 5 years ago of $14.5 billion to 1 year ago of almost $18 billion, increase of 23.79%, and again looking very, very good within the past 5 years, increasing consistently. And we do see that dip once again in the revenue from 3 to 2 years ago, just like we just saw with the free cash flow. So I'm gonna take it, guys, as a COVID related number, so I pretty much ignore it. Essentially, guys, when it comes to the profit metrics, everything looks really good except for that net income. Don't really know what's happening here, but I think that we can pretty much give it to like a fluke, I guess you could say. We shall see what happens with this current year's net income and see where we land once we get that number. But all in all, really good, solid profit metrics when it comes to waste management so far. Now analyzing some balance sheet numbers, the difference between total assets and total liabilities is first. Guys, you want a company's assets to be way above their liabilities, because if this is not the case, then the company might go insolvent. So yeah, very, very important. You want this number to be, for starters, positive, and second, you want it to be consistently increasing year over year. So currently, when it comes to waste management, they are at $7.14 billion in this difference, and within the past 5 years, they have consistently increased this. However, they did take a little bit of a dip of around $3 million from 2 to 1 year ago, and they kept it roughly the same from 1 year ago to today, but roughly, guys, it's still fairly good. Average total assets is around $26.6 billion. Average liabilities around $19.8 billion. And doing this difference, we get $6.8 billion. Now let's actually take a look at whether or not the company is able to use their free cash flow to pay off their liabilities. What I've noticed from this metric, guys, is that companies tend to have this in the negatives. But what I like to look for is essentially, are they increasing their cash flow more than they are increasing their liabilities? Essentially, getting this negative number closer and closer to zero. Cash flow is what companies use to lower their liabilities. So looking at waste management, this is not really good to see, right? From 5 years ago to today, guys, they have been getting deeper and deeper in the red. They currently hold negative $19.5 billion in this difference. And on top of that, guys, but on the bright side, take a look at this, right? They reached their lowest in 2020 because of, again, the pandemic. Fairly surprising, but ever since 2020, they have increased it by around $600 million or so. So it's heading in the right direction. We shall see where this goes in the future. If we take the average cash flow and subtract the average total liabilities, we get negative $17.4 billion. And now let's take a look at the metric that companies tend to fail, the shares outstanding. Guys, you want this number to be decreasing. I can't stress this enough. The more this thing decreases, the more ownership of the company you hold by default. So very, very important that you want this number to be decreasing. Now, some companies issue shares because they might feel that their share price is overpriced. So they're like, let's just issue shares, right? So that way we can use that cash to pay down our debts. I think that's a pretty logical thing to do, but nonetheless, the fact that they are diluting you by doing this is still a bad thing for you. Now, Waste Management is doing a fairly good job at this, of buying back shares. 5 years ago of 433.3 million shares to today, guys, of 415.2 million shares. That is a decrease on the 5 year of 4.18%. And from the previous year to the current year, this is looking at 1 year ago to today, this is they bought back, guys, at around 0.22%. So overall, they are buying back shares at a pretty decent rate. And lastly, when it comes to their cash and equivalents, guys, Waste Management currently has $155 million in cash and equivalents with an average cash and equivalents of $745 million. And now, guys, let's come over here to some assumptions using 3 different factors: the revenue growth, the projected share buyback, and of course the required rate of return for a low, median, and high assumption. Guys, for the revenue growth, let's come over here to Seeking Alpha's growth tab, and we can see that the revenue growth year over year is 18.45 when it comes to waste management, and the revenue growth forward, it is estimated at 10.24%. So let's take this into account. Now, my job as an investor is to be conservative when it comes to making these assumptions. I have to think of every possible scenario that might go wrong, even at my highest assumptions. So, seeing that the revenue growth year over year is 10%, let's go, guys, with 7% for the low assumption, 10% for the highest assumption, and 13% for the highest assumption. Now for the predicted share buyback, guys, we see that they are buying back shares at around 4% or so. So let's just say that they will continue to do this in the next upcoming years, but just at a lower rate. So for the lowest assumption, let's say at around 2%. For the median assumption, it is 3%. And for the high assumption, let's say 4%. Now, guys, that we have done this, we can actually see that we got some target share prices here. Not adjusting for debt, we get for the low assumption of $89.84. Median assumption, we get $100.39. And for the highest assumption, we get $111.93. Now adjusting for debt, guys, we do this by adding the cash and equivalents and the net debt together. And clearly, if they have more debt than cash, then this number comes down. And if they have more cash than debt, then this number comes up. As you can see, it does come down, guys, by around $30 or so, right? For the lowest assumption, now we get $57.46. For the median assumption, we get $67.68. And for the highest assumption, we get $78.89. Now, adding a margin of safety on top of this, guys, of 5, 10, and 15%, this puts me between the range of almost $49 all the way up to $54.59 for the lowest assumption. For the median assumption, it is $57.53 to $64.30. And for the high assumption, it is $67 to almost $75. Guys, the current share price is $155.90. That is very, very expensive in accordance to my assumptions. You can see pretty much everything is still way under this current share price. Now, guys, this is based off of my assumptions. You guys saw me input all the numbers. Every investment is the present value of all future cash flow, and this isn't financial advice. It never is, right? I'm showing you guys public information and my opinion as to what I think this company's revenue growth and predicted share buyback will be in the next 4 years. You guys should make your own assumptions. That's why I have this calculator available for free. Anybody can have it, just so that way you guys can make your own assumptions and see where your numbers lie, right? Because if you don't agree with me, let's just say that you want a lower required rate of return or maybe a higher required rate of return. You think that they won't grow at 13. You think that they'll grow at like 20%, right? And you think that they'll buy back shares at like, I don't know, 8% or so in the next upcoming years, and you want like a 12.5 required rate of return. Well, that pretty much just shows how much these numbers change by, right, guys? So you guys should make your own assumptions as to how you believe this company will grow in the future, as well as, guys, you can even change these margins of safety to your own liking as well. I also have a book value calculator, guys, and a reevaluation and a dividend tracking sheet, guys. All I'm asking for in return is just help me grow my channel. I'm giving you guys these free calculators, a dividend tracking sheet, and pretty much daily content, sometimes even more than once, right? All I'm asking for in return is just help me grow my channel. Thank you so much for everybody who have subscribed. I really do appreciate it, and hopefully I can get more of you guys to follow and, you know, just grow this community as a whole, because I like to provide content and teaching people in how to invest using a fundamental process and not just hype, just so that way when you guys see stocks fall, right, you actually get excited for seeing red because you have understood why you bought the company in the first place. And if everything remains the same, then you should be willing to buy more of a good company, like for example, like Waste Management. That is essentially the kind of investing I like to follow, and that's what I'm trying to teach all of you guys, just so that way when you guys see red, you guys actually get excited instead of panicking. Now with that said, guys, let's take a look at this dividend, because this company does pay out a dividend, and a lot of people like this company, well, for their dividend. Now, obviously, the share price is expensive in accordance to my assumptions, but nonetheless, let's say that you make the average US income at $68,703. This comes out to be $5,725 monthly. And at the current share price, guys, if you were to put in 1 month's income, this would get you 36.72 shares, and at the current annual dividends per share of $2.60, this company would pay you annually $95.48, quarterly of $23.87, and monthly of $7.96. So unfortunately, as it stands, this isn't that really much of a good value, right? But then again, the fact that all of my assumptions are saying that I need this thing to fall a little bit more, right? Probably if it does fall to this level, then the dividend will be significantly higher at that point, right? Your $5,725 would buy you a whole lot more shares than at the current point. Therefore, your annual dividend should also be higher as well. So all in all, good company when it comes to a dividend perspective, but the share price is a little bit expensive for the moment. All in all, guys, as I said, I absolutely love this company. It's boring. It is a garbage company, and I mean that literally, right? They pick up garbage, so it doesn't get much boring than that. And well, I don't think a company like this will ever go out of style because people will always have garbage. So we always need somebody to dispose of our garbage. So I think this company has a really, really good solid moat. And because of that, their fundamentals actually don't even look that bad either. I personally love this company, but unfortunately right now it is a little bit expensive. That pretty much does it for this video. Like the video, comment, subscribe. It really does help here with the algorithm on YouTube. You guys can follow me on my new tech sites, link in the description below. So with that said, peace out and be on the lookout for the next stock analysis video.